In order to fully understand the different types of orders that can be placed in the market as a securities trader, you must first understand that there are always two prices in the market for every security. There is the bid price and there is the offer or asking price. The bid price is the price at which someone is willing to buy securities that you want to sell. A good example for this would be, think about a silver or gold bullion dealer. You have a 1 ounce gold bullion round. You take it into that gold bullion shop and say, I'd like to sell you this coin. That gold bullion dealer will offer you a bid price, the price at which they're willing to pay you to buy that coin from you. Likely this will be slightly below the spot value of silver or gold. This is a good analogy to remember the difference between bids and offers prices. An offer price would be the opposite of this scenario, the price at which you're willing to pay to buy securities out of, a dealer's inventory, right? Or in the analogy of using silver and gold trading, you walk into a gold bullion dealer and say, I would like to buy 1 ounce of gold. They will sell you gold probably at a price slightly above market value, and the difference between the price you're willing to pay, the bid, and the offer is known as the spread. So remember, the bid price is the price at which someone is willing to buy securities that you want to sell. The offer price is the price at which someone will sell you securities that you want to buy. When a customer wants to buy securities, the customer wants to buy it at the lowest offer price available in the marketplace. When a customer wants to sell securities, they want to sell it at the highest bid price available in the marketplace. So, a customer's buy order will always be executed against the asked or offer price, and a customer's sell order will always be executed against the bid price. The combination of the highest bid price and the lowest offer price is known as the inside or best market for a stock or security. This is the price at which a customer wants his or her order executed at when it comes to the market. You want to get the best price. Now let's look at specific order types that a customer can place in the market in order to get those best results and prices. First, we have a market order. This is an order that is executed immediately at the next best available market price. In a market order, a customer specifies the securities and the quantity. I want to buy 100 shares of FKDNX at 120, or I want to sell short 200 shares of Apple. In a market order, the customer specifies the security and the quantity. The order is executed immediately as soon as it hits the market. This is very important to understand because I know this confuses some people when they're learning this information for the first time. A buy order is executed against the lowest asked or offer price in the marketplace, and a sell order is executed against the highest bid price in the marketplace. So a customer will get the best execution on a market order at the time the order reaches the execution. A variation on the market order is the market not held order. This order type gives the floor broker or trader discretion as to the execution price of that security. Right? So a customer cannot question the price, and the floor broker or trader is not held liable for the execution price. This is typically used by institutions primarily when they have confidence in that trader that has the right intuition about the market's direction in order to get the best available price for an order that will be executed perhaps throughout the trading day. Next, we have a limit order. With a limit order, the customer specifies a price. Example, buy 100 shares of PRI at 60 or sell along 100 shares of Apple at 120. Notice they're specifying the limit that they're willing to take. When the market passes through the customer's specified price, the order is eligible for execution, but it will only be executed at the customer's specified price or better. So let's look at a simple example for this of what or better means. You've been following IBM stock. It has dropped from 100 down to 80, down to 75. And you now believe that it's going to fall even lower. In your mind, you'd like to buy it at 60 or lower. So you place a buy limit order at 60. As the stock goes lower and lower and lower, and it hits 60, your order will become eligible for execution at 60 or lower, but never above 60. So if the market rises above 60 before your order is executed, you will not get an execution. You specified the best price you're willing to take. Let's look at how some of these orders are placed. A buy limit order is always placed below the market because you're trying to buy in on a dip. When the market's going down, everything's on sale. A buy limit order is always placed below the market because the customer is trying to sell long or sell short at a peak in the marketplace. SLOBS above, BLISS below. We'll go over this in just a minute. It is very important that you understand how these orders relate to the prevailing market price. The next type of order is a stop order. People often confuse stop and limit orders. With a stop order, you specify a price. You say buy Apple at 120 or sell IBM at 60. Although in this case, the price that you specify is nothing more than a trigger. When the market passes through that specified price, your order will become a market order, and it's elected, becoming a market order, and it will be executed at the next best available price at whatever that market price perhaps happens to be, either above or below the stop price. You have no control over this once it's elected. It's essentially just a trigger. Stop orders are used completely different from limit orders because with a limit order, you specify the best price, the price you're willing to take. A lot of people know a stop order as another name, a stop loss order, and this is because it's used to limit the losses on a stock position. Let's start out by looking at a long position. You bought Apple Computer when the price was at $50 per share. The stock has risen up to $150 and you're blissful with your gain, but you're also worried that the price is possibly going to decline. You decide that it might be a good idea to place a sell stop order at $135. The price of the stock starts to drop. It hits that $135 mark. Your order is triggered and transformed into a market order and is then eligible for execution, and it will be sold out at the next trading opportunity. So it's important to remember that one trade elects your order, turning it into a market order. That would be a stop order, and then your order is eligible to be executed on the next available trade, whereas one is specifying a price. Let's look at an example using a buy stop order. You've sold IBM at $100 per share, and the price has dropped and dropped and dropped all the way down to $40. You're blissfully happy because you have a $60 gain. You shorted IBM, but you're worried that the price may begin to rise, so you place a buy stop order at 50. The price begins to rise. 41, 45, 48, 49, 50. When the market hits 50, your order is elected, becoming a market order, and it will be executed at the next best available price, buying in the short position. So a buy stop order is used to limit losses or protect profits on a short position. And as you will notice, in the example I will use here, a buy stop order is placed above the market. So let's summarize what we have learned so far about the placement of limit and SLOBS and buy limit orders. A buy limit order is placed below the market. A sell limit order is placed above the market. A buy stop order is placed above the market. And a sell stop order is placed below the market. It's very important for you to keep this in mind. And this is the chart I talked about. SLOBS above, BLISS below. This is a good analogy to help you remember these market placements. SLOBS, S-L-O-B-S, above. SLOBS above. Sell limit order, buy stop order above the prevailing market price. SLOBS above. And BLISS, buy limit, B-L-I-S-S, sell stops. So buy limits and sell stop orders are placed below the current market price. BLISS, B-L, buy limit, S-S, sell stop. So SLOBS above, BLISS below. This is very self-explanatory once you start to, answer a few questions and relate to this analogy. And if you just write this out on your whiteboard, on your paper or whatever on the day of your exam, you won't have trouble. So if you ask yourselves, SLOBS, sell limit, where is that placed? Above. What about BS? Where is that placed? BS, buy stops, that's always placed above the prevailing market price. What about BLISS? Where is the buy limit placed? Below. Sell stop, where is that placed? Below. BLISS below, right? You can see how this is pretty self-explanatory and straightforward. This is how these order types are placed. So it's essential to understand these order types. Remember also that with a limit order, if the market hits your price, your order will only be executed at your specified price or better. However, with a stop order, it is a trigger. When the market hits your price, your order becomes a market order and you get whatever the next available market price is. The next market type of order is a sell limit order. This is difficult order to understand, so I'm going to slow this down a little bit. Let's start by illustrating this type of order. You want to buy 100 shares of Apple at 120 stop and 121 limit. Or you want to sell 100 shares of IBM at 60 stop, 59 limit. As in all cases with a stop order, the stop price is nothing more than a trigger. When the market hits the stop price, the order is elected, becoming a limit order, not a market order. It becomes a limit order to buy at the limit price or better. So in our first example with Apple, what the order is actually saying is you want to begin buying Apple when the market hits 120, but you don't want to pay any more than $121 per share. In the case of IBM, you want to begin selling when the market hits 60, but you don't want to sell any less than 59. This order type places a limit at which you want the trade executed, unlike a regular stop order, which becomes a stop order or a market order at the next available market price. So you'll see that a buy stop order or a buy limit order is placed above the prevailing market price, and a sell stop order is placed below the prevailing market price. These types of orders, stop limits, buy limits, and sell stops, are known as contingency orders as a group. Why? This is because their execution is contingent upon the market hitting the price specified in the order. These orders are always placed either above or below the prevailing market price. SLOBS above, BLISS below. So how long do these orders stay in the market? If there's no specified time on a sell limit, buy stop, or sell stop order, then it is a day order, and it will be canceled at the end of the trading day if it is not executed. If a customer wants a limit, stop, or stop limit order to stand in the market longer than one business day, then it must have the notation GTC, which stands for good till canceled. Let's look at a chart at which I have placed the various types of buy-sell limit orders. I'm going to leave stop limit orders off of this chart because they're not tested relative to this information that we're about to go through. Just to repeat, so we're all using the same analogy and information, a buy limit order is placed below the market along with a sell stop, which is placed below the market. A sell limit, SLOB, is placed above the market, along with a buy stop, which is also placed above the market. SLOBS above, BLISS below. If these orders have the notation GTC on them, they are often referred to as open orders, standing open the market longer than one business day. So you can have open buy limits and open sell stops below the market, and you can have open sell limits and open buy stops above the market.